In Investing 101, James Brewer of Envision Wealth Planning joins me now to do some risk management. Good to have you here.
Always a pleasure.
So when you're doing your retirement portfolio or planning, you always want to consider the risks that might be involved, and you really have to know how to manage those risks. So I think a lot of people, one of the issues they have is they're afraid of running out of money, and that is a big risk because people are living longer.
Yeah, so that is the number one risk where you have to think about outcomes. But then I think that there are three other risks, and the good thing is that you can actually control one. And that's first is accounting for your longevity. We're all living longer now. The other thing is saving enough. And the third one is how you should manage your investment risk.
So how should you manage your investment risk?
Well, I think the first thing you have to do is start by hiring a certified financial planner to help you do a risk assessment. It's usually called a retirement needs assessment. And that'll help you figure out how much you need to save for the time period that you need to save it and at what rate of return. And I did some numbers to try to, color this out. So let's say that you believe that you're going to live for 25 years or so, you need $25,000, then you would need roughly like $500,000. Well, to get to $500,000, you could either save about $6,000 if you have about a 30-year horizon at 6%, or you could target, say, 10% and only have to save $3,000.
That's not a bad plan at all. So somebody could set this up with or without a financial planner. I mean, it's great to have advice, but sometimes people can maybe just look at their situation and just do some calculations here, it sounds like.
Well, I actually oversimplified it just to illustrate. So I know that there are people who try this on their own, but I just say it's too important for you to get it wrong. And then once you actually, now the part is a lot of people would tend to, well, hey, why not go for the 10%? Well, the 10% does have its own risks. And over long-term investing, you have the ability to take your time. You don't have to go for 25% returns. You can go for small. In fact, the Employee Retirement Income Security Act, which actually governs your 401k, it says that you only really need to have 3 investments. In fact, the employer is bound by law to give you 3 investments, but the 3 have to be different in terms of their risk and return profile.
Because you always want to be diversified?
Well, yes, and it's built upon Harry Markowitz, who is a professor at University of Chicago who won a Nobel Prize for this. But basically, I like to kind of do an analogy. If you kind of mix salt and pepper, if you didn't put any pepper, it'd be really salty. But if you had lots of pepper, it's really spicy. But if you kind of start to blend them together, you kind of create some different profiles. Think of that in building portfolios. So by changing the percentage, let's say, of stocks to bonds, we start to change what your portfolio will have an expected return of.
So those 3 areas, cash, bonds, and stocks?
Yes.
Okay, and then you just have to divide them up, but that's where the management comes in because it depends on your age, correct?
Well, I think it depends more on that dollar amount that you need to achieve. So if we start with, again, that $500,000, if that's what you need, and you have 20 years or you have 30 years, then that will give you some guidance on what you need to do. But when you blend and find the right blend for you, compared to what you're saving. So you can't really control what the markets do. We don't control the bond market. We don't control the stock market. But you can budget, come up with a spending plan, and you can determine how much you can save. Then I think for a lot of people, you'll sleep better at night if you're saving what you need to save and let the markets do what the markets are going to do, aligned with the expected return that you need.
Wonderful. Thank you for coming on the show.